Praise be Jesus. Thank you for joining us. The Gold Standard, we're looking to synthesize hundreds of headlines into a few important stories and trends for you this week to help you make better decisions as capital allocators. So a few things that were positive for the financial markets and a few things that should be sobering, and want to try and objectively present them. First, in fairness, markets hit all-time highs yesterday as we wrapped up April. A few things we think they may be discounting. One is potential very positive outcome in the Mideast and the potential restructuring of the chessboard there to an environment that is much more supportive of capitalism, much less terrorist driven. Secondly, also in the Mideast, we saw the UAE announce this week significantly they are walking away from OPEC so that they can increase production of oil, confirming that they have a pipeline to get oil out to the world without needing to go through the Strait of Hormuz. So very negative for oil prices with that increased potential supply that we're looking at. And again, the potential peace breaking out there that would bring down inflation and would be positive for the markets for sure. And something that we would all love to see. A third reality that is supportive of the markets. We think that behind closed doors, America's advisory firms are having a excruciating discussion of how their clients are not set up in ways that are in their best interests. Reference strategist after strategist as a talking head from these advisory firms saying that real assets are going to outperform and that investors don't want to be in bonds. There's just one case study. Look at Merrill Lynch. Their strategist said the same thing, yet it appears Merrill Lynch has over $1 trillion, that's trillion with a T as in tango, $1 trillion in bond in their portfolios. Perhaps just as bad, Merrill's bond portfolios are often advertised as ultra safe to their investors. But at the same time, the strategy department's recognizing in an inflationary environment, there's nothing worse than bonds. So these advisory firms, we think, are going to continue to push people into equity type products to keep them in-house, make sure they don't lose the fees, no matter whether it's in the client's interest or not. They may talk about having access and exposure to real assets through ETFs, which are a step in the right direction, but fall greatly short of actually being real assets. So those are three tailwinds that we think objectively are supportive of the market. However, the question is, how much of an allocation does one want to financial assets in light of some very real concerns? Yesterday, as we closed April, for the first time, U.S. debt to GDP hit 100%. Historically, that is the level of banana republics. We can't find one case where a country had that happen to them and they didn't sail into an environment where their currencies lost purchasing power and where inflation was problematic. Those two devastating realities are very positive for the metals, very negative for financial assets. Additionally, we got some significant data this week, the Wall Street Journal reporting that OpenAI, who is artificial intelligence's poster child, badly missed numbers. It's estimated that OpenAI missed their revenue target by 60%, and they also missed their paid subscriber numbers. It appears that artificial intelligence, as subscribers re-up, are dropping off at a rate of 4 of 5. So 80% by some estimates of paid subscribers to AI products are not renewing. That was probably a contributing factor to the CFO from OpenAI saying skeptical that we will be able to continue buying at the rate we pledged to buy, meaning they were on the books of different tech companies for spending $600 billion, that's with B as in big, and now that's to buy chips from people like NVIDIA and buy other types of equipment to build out their platform. If they can't sustain that spending pattern, those numbers are going to have to come out of the estimates of many tech companies supplying into AI. Additionally, this week, in our opinion, we had a concerning event, and that is Steve Schwarzman, the CEO of Blackstone, the Wall Street financial firm, came out and said nothing to worry about regarding private credit or private equity. To us, his words were eerily familiar to what his former shop's CEO said a number of years back, Dick Fold, saying nothing to worry about. Naysayers are just fear mongers. Move along. So we are going to take the other side of that. Hope Steve's right, but consider we had an incremental update come out this week from Bloomberg, and they admitted, surprise, surprise, private equity, private credit really isn't the portfolio diversifier it was advertised to be. Instead, it just behaves like an equity. Well, that means these portfolios across the US, the pensions, the endowments who have been sold these private market products as portfolio diversifiers are not nearly as diversified as they thought they were. And that is a big problem because we do have, in addition to these debts, rich valuations by many metrics. Consider also Bain & Company just came out updating their survey of the private equity industry. They conclude that we now have an all-time record 31,000 companies for sale by private equity that are stuck in the pipeline because private equity is saying these companies are worth exorbitant amounts. The buyers are saying there's no way they are. The gap is because private equity has these private companies marked at valuations that are so high. If they sell them at the reduced level, they are going to have to take a reduction where they've told their investors their portfolios are valued. That will negatively impact the fees that they can charge. And we're already seeing shocking, in my opinion, behavior by these titans of finance. Private equity companies are now borrowing incrementally against the stocks in their portfolio so that they can pay LPs and also, by the way, pay themselves. So a conflict of interest, something that regulators should be interested in? We think so. Again, it is at least cause for concern because if these private equity companies can't get these equities out, you're talking about notable write-downs in private equity, which will flow into equity. Private credit will flow into credit. Valuations, we think, must come down. We also had a significant perspective check, we thought, from Deutsche Bank this week. First major bank coming alongside us in terms of expectations for what central banks are going to do. Deutsche Bank observed that even with the recent central bank buying of gold, they still are well below where central banks were when the Cold War era ended. Specifically, central banks can buy 50% more gold than they have on their balance sheet now, just to get back to the end of the Cold War era. If you consider how gold ownership by central banks was plummeting prior to the end of the Cold War, meaning they were sensing tensions were decreasing, capitalism was going to be spreading, the connectivity of the world was going to be improving, all things that were going to lower the risk premium, push people into financial assets. So if you think about before that event occurred, before the central bank started aggressively selling off their gold, when they were concerned last about inflation, central banks had 80% of their reserves in physical gold. Now, obviously, we can't ever guarantee anything about gold. However, we think that the probability is real that central banks are again going to become concerned about inflation for the reasons that we discussed. And we think we will have this now tailwind of central banks adding to their physical gold positions. So the takeaway is right now, sentiment in the United States among individual investors, and again, even among very sophisticated investors, is horrific around gold. Historically, that has been a great opportunity to step into it. When gold hit 1,000, then traded off $75. People said, how could I have bought it at 1,000? It was ridiculous. It's so high. The same story repeated when gold hit 2,000 and when gold hit 3,000. The only likely way that gold has peaked is if America is solving our debt crisis, and so is the rest of the world. Even if we have these wonderful outcomes that we're rooting for in the Mideast, it is not going to solve our dollar debt crisis. $39 trillion, and we believe that number is significantly understated. The math doesn't work out to pay that off without cheapening the value of the dollar. So our call to action with our investors is lean into this contrarian moment. Look at what the most informed players are doing. China just stepped up 17th consecutive month that they have bought gold. Their percentage of gold in the reserves is officially 9% and rising. We think it's multiples of that level as China is smart enough to make most of their purchases out of the view of the central public so that it is more clandestine and they don't have more competition for it. China also just set a single month record, all-time highs for their imports of silver, speaking to the benefit of that. Recall, China told their citizens as they look into the future, they believed wealth would be measured in gold and silver. They are moving in that direction. Americans, we don't want to be like deer in headlights. Think about this from the risk-reward perspective. Even if you're very bullish on everything, you go 80% into stocks and financial assets. By having 20% in gold, a number that the Sharpe ratio shows has optimized portfolios for the last 50 years, you still have plenty of exposure to the upside, which we hope will work out. But that 20% gives you a buffer of protection in case this debt crisis metastasizes. The probabilities, remember, are off the charts, unfortunately, that we are going to have major debt issues moving forward. Having the allocation to gold protects against that. And wrapping up, we have some news that we think is very significant along these lines. We believe we are now the first company, St. Joseph Partners, as of April 2026, to have innovated a way so that employers can allow their employees to continue working for them, participating in their 401k plan, and to allocate to physical gold without piercing the taxable wrapper. And we believe 85% from our initial estimates of the 401k plans that are out there will qualify for this enhancement that we can bring to the table. And we do it in a way that is a non-event from a cost perspective to employers. Employers, you want to do the right thing for your employees. If your employees are in their 40s or up, chances are as much as a quarter or a third of their net wealth is now in their 401k plans. And 401k plans are horrifically positioned if we get a market drawdown. You want to have this safety valve that history has said has been good diversification for portfolios as our debts continue to mount. Additionally, employers, it shouldn't be the driving reason, but think about how liable you are to have held so much of a concentration of your employees' wealth, concentration that older employees can never really hope to re-earn given their age, and not to have allowed them to diversify into the best hedge in history. You don't want that for legal reasons, and you want the best for your employees. And individuals who are out there, reach out to your employers, tell them about this. And you can tell them this isn't a scam. This platform is built off of our IRA performance driven solution. We have innovated a way to deliver retirement accounts that are audited, insured, segregated. We're talking in physical gold and silver for 10 basis points a year for working class retirement accounts. This platform won us recognition among an independent custodian who said that we were their top-ranked physical gold U.S. dealer. We didn't pay a penny for that. And again, they did tremendous detailed work into that to come up with that conclusion that we were doing right by clients. This is what we built on in the 401k product we offer. So it is timely, it is urgent at this point in time that Americans protect themselves as we're seeing the Chinese and these other central banks. So I implore you, if you love our country, and I know so many of you patriots do, step up with us. Let's do all that we can to protect our troops. Reach out to us. We would welcome keeping you up to date and bringing you along. We publish every day our prayer, our fasting schedule, trying to encourage you, making it easy for you to do so. We would love to have you join us in this crusade for our gallant patriots. Reach out to us also as it relates to the metals. We will gladly step you through what it takes to craft a solution for your family based on what history says is next. God bless, and God bless America.